how do you correlate the equity market melt up back to the denser, deeper market of fixed income and foreign exchange?
Yeah, well, I think the melt-up has certainly been helped by the melt-up in bond prices. So the fact that the 10-year has been hovering, close to 2.5% has been, I think, extremely helpful for the equity market. Keep in mind, when the Fed funds were roughly around zero, for that long stretch, the average 10-year yield was 2.5%. So we've got a lot of effective back-end monetary easing.
Now, Kane is gone at the Fed. Stephen Moore's gone at the Fed. I sent a note to President Trump last night and said he ought to think about appointing Friedrich Hayek. Let's go off Friedrich Hayek right now. Mr. Hayek has been passed away for a few years, folks. Let's go Friedrich Hayek. You have to clear markets. Are we in this jam, whether it's greater EU banking, the unfolding of Italy and Greece, and all the other big picture issues, because we're afraid on a Hayekian basis to clear markets, to solve things and move on?
Tom, it's a big question there, but I think you're hitting on a very sensitive point, which is that central banks have been babysitting markets for a long, long time.
Can we bronze that quote, please? That may be, December 31 quote. Babysitting, go.
And we've been very, very afraid of any of the cleansing that relates to any growth slowdown. And hence, we've had, things like the Greenspan put, the Yellen put, and more recently, of course, we've had what was seen as a Powell put. And it's not just the central banks. It's authorities elsewhere in the world that have picked up on this. The Chinese, for example, they have sort of underwriting growth effectively to keep growth around 6%. But you're seeing distortions all over the place, things that we could never have imagined, where central banks are buying assets and distorting credit and equity. Yes, I think you're absolutely right. A little bit of cleansing would be no bad thing. Not least, given where we're at. I think we should celebrate where we're at. We're 10 years into recovery, a recovery which has gone extremely well, things considered.
Okay, but so Alan, what are you telling us? That it needs to be rethought? That central banks have been itching to hike for quite some time, but inflation hasn't really been there. So what do they do?
Yeah, I think to some extent the central banks are targeting something that they don't control very easily. I think that's a huge problem, and that's why you see the markets trying to interpret, for example, Chairman Powell, what he said, just a couple of days ago. There's fear, I think, that if the central banks were to say, look here, inflation's 1.5%, we are hell-bent on getting inflation up in a symmetric way to say 2.5%. Francine, guess what type of interest rate that might actually involve the Fed targeting? It probably, on simulations that we've done, certainly involve a negative interest rate in the United States again. So, this sort of inflation targeting obsession, I think, is part of the problem. Unfortunately, central banks do have to take a very holistic view of a variety of different variables when deciding policy, and that's not an easy message. It's much easier just to tell the public, we're targeting this one variable in inflation.